Yeah. Okay, cool. All right. What up, everyone? Good evening. My name's Nick. I'm in the Profit Rocket Club. Uh, Proud to represent. Awesome community. Thank you guys for being here. Thank you, everyone, for spending your time to learn just more about technical analysis and chart reading. Hope that what I put together tonight helps you understand just the market a little bit better and that you can put this information to use. And ultimately, you take something away from this session. Um, so, yeah. There's going to be a lot of other things that I'm going to include. Like I'm going to start with the basics, obviously, just so everyone can kind of just understand the principles of what technical analysis is and kind of build on that on top of it. I'll try to make things digestible and in words and things language everybody can understand. I'm a teacher, teach fifth grade, and I love helping people, helping kids, and just, my mission is I want to make a positive impact on other people that I come across. So thank you guys for being here, and I hope you enjoy. So this is me. Quick disclaimer, I'm not going to read fully through it, but basically I'm not a licensed financial professional or advisor. If you're trading, only trade with capital you're okay with losing. That won't affect your lifestyle. Don't trade with money you can't afford to lose. Nothing that's being discussed today or in the Discord should be construed as professional financial advice. We're not responsible for any losses you incur in the market. Everything is within your responsibility. Cool. All right. So just some quick table of contents. I'll just explain why people use technicals, why and how does price move on stocks, what are trends, support, resistance, volume, how to read candlesticks. Realize I put that twice. Indicators and how to plan your trades using technicals. Cool. All right, so why technical analysis? First, technical analysis can give you an edge in the markets, right? What is an edge? An edge is defined as having one thing that has a higher probability of happening over the other, right? So it's kind of like you flip a coin, heads or tails, 50-50, right? But if you mess with the coin a little bit and if it lands on tails more than it lands on heads, then that's an edge, right? Or a casino makes money because they have an edge. They have the house rules, and they make money off people gambling, right? Pass price, or like you play a sport and like basketball, you know how to shoot really well. So if you know how to shoot really well, then you're gonna make more shots than you miss, right? Kind of like that's pretty much what an edge is in the most basic terms. Past price action, right, shows behaviors and cycles that happen, and they could repeat themselves in the future. Maybe not the same way, but they could repeat themselves in the future because human behavior since the beginning of time hasn't really changed, right? Another thing is price as memory. So if you think back in time, that price was at this certain price a year ago or a couple months ago or a week ago, that it may possibly react the same way when it gets to a certain price again, because people are literally participating in the markets, right? You can identify how high or low the market has been before, yesterday, the past week, month, couple months, year, right? And look for targets to enter and exit your opportunities to trade. You can also anticipate certain movements in the markets before they happen, right? You can try to make a prediction or try to forecast a price in the future based on what has happened already. And you can also react to what's happening in front of you for my day traders, right? And take trades with conviction because you have an edge where things are higher. Odds are in your favor, right? The odds are in your favor, but doesn't mean it's 100%, right? It means more than likely this could happen other than that. And we'll get to more of that later. So comparing price action to technicals, basically price action is like what's happening right in front of you. You tune into the market from 9:30 to 4 and literally you see things going up and down. That's price action, right? Being able to react to how it moves in real time. You'll be able to look at entry triggers to get into a trade or to exit. You're looking for a confirmation signal to give you more confidence in a certain direction, looking for signals that tell you that you can exit. You don't really need indicators, and we'll get more into that, but you're strictly just following the price of an asset and the volume, how many shares are being traded per day. And you're reacting to different levels of aggression between buyers and sellers, right? You're reacting to When things go up, things go down. How are you reacting to it? What's happening here, right? And what could happen based on what's happening in front of you, right? Technical analysis is more so studying what has already happened, right? It already happened. You kind of scroll left side of the screen, and the previous days, hours, minutes have already happened, and you're studying that to probably make a prediction or forecast of what could happen in the future, right? People use technicals to believe that they can determine the direction or what could happen in the future, right? You're identifying the trend or direction. You're identifying the areas of value where price tends to reverse or continue. You're looking for entry points where you believe is fit. You're choosing price targets that are reasonable because they have a high probability of getting there. And you're creating a game plan of potential trading setups that have a higher probability of working out in your favor, right? So you're using a chart to add to your toolbox, and you're finding an opportunity that you define as a good opportunity to invest, to take a trade, and the odds are more in your favor. You're finding setups where the odds are more in your favor of this could have a higher probability of happening over another, so that your chance of profit is higher than your chance of loss. So first off, right, before I get into anything else, it's not the holy grail, okay? It doesn't mean you can just look at charts all day long and know what's gonna happen next, because honestly, anything can happen, right? You still need to know how the markets work on a fundamental basis of what is the stock market, why are people participating in it, what are stocks, what are bonds, what are options, what is volume, what is moving at, like you still need to know what the market is like, the sectors, the indices, all this stuff, right? You need to know that. But as a trader, being able to read it, right, being able to look at a chart and read it and know what is high, what is low, where do you want to get in, where do you want to get out, you can find high probability trading setups, right? Because you know where you want to get in, where you want to get out. If you're using strictly fundamentals, you're evaluating companies or assets based on business analytics, right? Based on their balance sheets, their cash flow statements, their income statements. Are you using fundamental analysis? But that doesn't give you an exact price as to where you want to get in and get out, right? That's also completely up to opinion based on how people value companies. It's like you see analysts every single day, upgrade, downgrade, price target increase. Like, that's based on fundamentals, right? It's also possible to anticipate price movements before the news or catalysts, right? News, catalyst, that drives people to want to do things, right? That drives people to want to buy or sell. That causes people to want to buy or want to sell any asset, and that causes price to go up and down. We'll get into that a little further. But basically, you can't just only rely on technicals. You have to know a lot of other different things, whether you're investing, whether you're trading, right? To have a complete toolbox so you can become a more complete, more intelligent, more patient investor. Any questions so far based on what I went over? Okay. All right. Okay, this is a quote that was in the almanac. I thought it was pretty cool. It's no coincidence that 3 of the top 5 stock option traders in the recent trading contest were all former Marines. So in the chat real quick, why do you guys think that? Why do you guys think top 3 out of the top 5 traders were all former Marines? What could they all possibly have in common that would make them a top trader, right? Mentality, emotionless, right? Discipline, right? What would they have to go through in order to kind of be able to be successful in trading, right? Not being caught up in emotions, right? These are all very important things, right? Cool. So why and how does price move? Okay, this is the most basic principle, most basic reasons as to why and how price moves. Okay, so first of all, the price of assets in the stock market is determined by the investor, right? Maybe me and you, maybe the institutions, right? Determined by how we feel what the price should be, right? So there's 3 groups of people in the market: people who buy, people who sell, and people who are waiting on the sideline to participate. Maybe they're holding, maybe they're not holding, maybe they have FOMO, maybe they want to get in, maybe they want to buy because they don't have any, maybe they want to add, maybe they want to trend, maybe they just want to take profit and get rid of everything, right? There's 3 groups of people: people who are buying, people who are selling, and people who are waiting on the sideline, right? So when there's high demand of something, right, a new Christian Dior Jordans drop, right? People will drop bread for that, right? Buyers will show aggressiveness to buy. People get greedy, right? People hear news, they like it, they want to buy, they're gonna buy it, right? They don't care what price it is, they just want to buy it. So they're willing to bid a higher price because they want it right now, right? Think about on your broker, you can literally click a few buttons and just buy it right then and there, right? So think about a collective mass of group of people who are all doing the same thing that want something right now due to greed, right? They're willing to bid higher. So if they're willing to bid higher, people have to sell to them. People have to sell to them, and they're gonna have to raise the price to sell it to them, right? So coincidentally, price will go up because there's high demand for something. There's low demand, right? People don't really want it, right? It's too expensive, right? I don't want to buy it right now. I'd rather wait for the price to come down and then buy it. So what happens then? People who need to sell it need to decrease the price that they're gonna sell it for. So people who don't like the price because it's too high, they want it lower. Now the people who are selling have to drop their prices so people can buy, right? So sellers will start aggressively selling because they want to get rid of it. They don't want it anymore. They just take profit, whatever, right? They want to get rid of it. So they have to lower the price so that the buyers are willing to buy again. All in all, right, price is moving because of shift of supply and demand of a stock. How investors are feeling about this price and what they're willing to buy or when they're willing to sell it at, okay? So key, supply and demand, okay? High demand, low supply, price goes up. High supply, low demand, price goes down, right? Cool. All right. When they're more aggressive buyers, right? Aggressive mean like large orders, massive group of people wanting to buy it. And the price goes up. When the more aggressive sellers, massive group of people selling, they're gonna sell the price and they're going up. They're fearful, they don't want it anymore. Oh my God, I'm panic, right? Things are dropping, I'm gonna sell too, right? Their price is gonna go down. A market maker, okay? A market maker also is a specialist. There is someone who's working for a firm and they hold the risk of providing liquidity to the market. So they own like massive amounts of shares so that people can buy and sell. So they profit off very small differences between the bid and the ask price. The bid price is the price buyers are willing to buy at. The ask price is the price sellers are willing to sell at. So the spread is the difference between the bid and the ask. So on stocks that have like high volume, like Apple, Microsoft, or like Tesla, right? The spread may be smaller because a lot of people are constantly buying and selling, right? There's a lot of action going on. And there's lower volume on stocks like Shopify or like ServiceNow, NOW, right? The spread is larger because not a lot of people are actively participating in it, right? So the market maker is ready to buy and sell shares to and from investors. So if people want to sell, the market maker is going to buy it from them, sell it to people who want to buy, so on and so forth, all day. It's computerized, right? Some stocks are very large and maybe multiple market makers, right? So when you buy a share, you put in an order, you're putting an order, it shows up on the order book, somebody has to sell it to you. So the market maker is taking in control of those transactions, right? They're kind of just determining the bid and the ask price, what the price should be. Very basic, right? This is how price moves up and down. This is why price goes up and down. Okay, any questions about that? Okay, all right, cool. Hopefully this has helped you guys kind of understand why is things going up and down, right? The very bare basics of it. So another quote, okay? I dropped some quotes and stuff throughout this presentation, so hopefully you guys like those. They're all from books that I've been reading. So anyone with average intelligence can learn to trade. This is not rocket science. Agree or disagree, right? Honestly, if you've taken it upon yourself to trade or invest, it's not rocket science, right? Anyone can learn how to do it, right? And this is William Eckhart. He traded commodities with Richard Dennis back in the day. Look those two guys up. They're made millions in the stock market, and this is his return since like the 90s to now. So if you invested with his firm, right, this is the return you would have compared to investing it with the S&P 500, and I don't know what the alt difference is, but I pulled this from Google. So yeah. All right, trends, support, resistance, volume. This is like also bare bone basics of when people are mentioning this stuff in the chat or you hear things like that, right? This is what they're talking about, okay? So how to identify the direction of the price, right? Price goes in two directions, up and down. Okay, price goes up, price goes down. That's it. Okay, you can identify the trend over a period of time. So over a course of days, months, years, what is the overall direction of the price? Okay, that is what the trend is, right? An uptrend is when there's high demand. There's high demand for something and low supply. So what happens when there's high demand, low supply? Price goes up, right? Price goes up to persuade more people to let go of their shares so people can buy them. Downtrend, direction is down, right? High supply, low demand. The price has to drop so that people can buy it again, right? Back to our supply and demand lesson in the first part, second part, right? Trendless, sideways, range bound, same thing, right? There's no true direction, neither up or down. So you'll find certain stocks or assets where there's no real true direction in the past maybe year or 2 years, couple years, or in the past month or two, right? Trendless, no direction, kind of up and down, unable to go higher, unable to go lower. It's kind of just sticking to a certain range. So in an uptrend, the peaks and the valleys go higher and higher. So I'm gonna screenshot this real quick to show you what I mean. Okay. So boom, right? Let's say this is lines. Let's say this is lines. This is kind of like this, where the peaks and the valleys are getting higher and higher, right? That is an uptrend, right? Now, a sideways trend, not really going anywhere, right? The peaks are not getting higher. The valleys are not getting lower or higher. It's just kind of just chilling, right? It's just very condensed or congested, okay? Areas of congestion. Now, a downtrend is when it's heading downwards. The peaks are getting lower. The valleys are getting lower. So think about peaks and mountain tops, peaks, and mountain valleys. That's an easy way to look at the chart, right? Are the peaks getting higher? Are the valleys getting higher? Or are they getting lower? Or they're not really showing a real direction. You have to decide based on your interpretation, right? Sometimes it's very clear to see what the true direction is, right? It's like you draw an arrow to show that it's going up, you draw an arrow to show it's going sideways, or you draw an arrow to show it's going downwards. You want to know what the direction of an asset is before you even touch it, right? You need to know what is the direction. Okay, so I'm gonna go through some charts. Type in the chat, what is the direction of Apple? Up, down, or sideways? You can type in chat or you tell me, what is the direction of Apple, right? It said moon. Yeah, up, right? It's pretty clear. The peaks and the valleys are getting higher since like the year 2007, right? Genius brands, what is the direction? Said up and it's stuck, yeah. Down, right? Kind of down, sideways-ish, but overall down, right? Okay, IBM, what is the direction of IBM since 2012? Yeah, that was for Apple, down, right? So you got to know what's the trend. I automatically 10 seconds, you see what is the trend is. That's the true direction of the stock, right? Over the course of multiple years. The tide, right? What is a tide, right? And then AT&T, what is the trend of AT&T since 2003, which is like 18 years ago, right? Sideways, kind of ish, right? Sideways, downish, right? Not really going anywhere. So you ask yourself, do you want to invest in stocks like Apple and Microsoft, right? Or do you want to invest in stocks like Genius, IBM, AT&T, right? You want to buy or, buy calls or whatever on stocks like AT&T, IBM, or Genius, or would you rather do that for stocks like Apple or Microsoft, right? So if you've been paying attention to my watch list, all the charts of those stocks look like this, right? Why? Because the true direction of the stock is up. The tide is going up. So if the tide is going up, then it pays more to go with the tide, right? It doesn't pay more to go against it. It's like a highway. You try driving against the highway, you're going to get killed. You're going to kill other people too. You just drive in the direction of the highway, you go with the flow, right? So boom, areas of support or resistance. Support resistance fancy words for high and low. Okay, support is where investors like a certain price level. They like it. They want to buy it because they like the price, right? So they're gonna buy it at a certain price. They're gonna support the price, right? That will increase demand. So there's demand in that area, and once the price gets to that area, people are looking to buy, and that causes price to go up because when demand goes up, price goes up, right? Resistance is prices. Investors don't like it. Too high, right? They don't like the price. Too high. So they don't like it. Price is being resisted, right? It can't go higher. So if people don't like to buy at that price, what happens when there's less demand, right? When there's less demand, price has to drop to meet that demand. So price moves in a series of highs and lows. The market can either go from a low to a high or high to a low, right? So if we go from a low to a high, high to a low, you can identify a series of peaks or a series of valleys in the same area, and you can mark off an area of support or area of resistance. Okay, buyers like to buy the support on an uptrend. Sellers like to sell at the resistance to take profit. Right? Able to rewatch? Yeah, of course. We're recording it, going on YouTube. So yeah, support, resistance. Just look at a chart and just see, okay, where has it gone high? Where has it gone low? Where does it bounce? Where does it reject? That's support, resistance, right? Okay, AMD, right? I'm just pulling up stocks that you guys all know, right? AMD, area of resistance at 94, 95-ish, right? Notice I say area, because it's not one price. Sometimes it could be area, right? It could be from 94, 95-ish, right? So don't ever just think about support resistance as like one line, one price. It could be an area, okay? So notice how it gets to 94, not enough buyers to support it there. People are gonna sell. People are gonna take profit, right? Why wouldn't you take profit? You bought it at 60, now it's 90. Right? Or you think price is too high. You're gonna sell and wait for it to come back down to buy. Support around that 74-ish, 73-ish area, right? You see how every time it gets to that price, it bounces. Why? Because people want to buy it. They think it's a good price. They think AMD at 74, 73, it's a good price. It's a discount, so they're gonna buy it. So automatically on the chart, you can see, okay, where is price tend to reject? Where is it bounce? And those are your support resistance areas, right? Very easy to mark off. Is there support resistance and broadening indicator? You could find one, probably, yeah, highs and lows, but you can just mark it off on the chart, manually. Square. Okay, so one thing about square. Notice how previous resistance, right? I'm gonna get into my artiste. So look at this previous resistance, right? So here, people sold resistance, right? And then it broke out, right? It broke out here. Then it came back down. Now support. That is like an A+ setup. Okay, let me explain the psychology behind that. So people sell. Okay, why do people sell? They think price is too high, it should go down. Bears like to sell. Bears short, right? So what happens when price goes higher? The bears get wrecked, right? The bears lose money when price goes up. People who short lose money when price goes up, right? So if bears lose money when price goes up, it's here right now. Bears are taking an L. They're red. What happens when it comes back down to the exact same price it's shorted at? They're gonna relieve their pain and say, you know what, I'm at break even. I'm finally gonna get out, or I'm at a very small loss. I'm gonna get out. I was wrong. You know what? Price can go higher. I like the price now, right? They're gonna buy. So does that psychology kind of explain? So previous resistance, people like to sell, people don't like to buy. Then it gets through. So they get through, the bears get wrecked, the bulls have FOMO because they missed the price. They should have bought it there. What happens when it comes back down? Comes back down, bulls like to buy it. Well, I missed the first time, so let me buy it now. Bears are red, so now they break even. I'm gonna get out for break even or small loss, and let me join the buyer side, right? So resistance turns to support. This is an A+ setup. Okay, so look at previous highs. If it comes back down to that high, there's a potential, right? It doesn't work all the time. There's a potential that it could bounce there and continue higher. You look for certain amounts of touches. No, personally, the more extreme wicks, right? The more extreme bounces, that's a strong area. The more times the area gets tested, it gets weaker, right? Think about, you take a hammer, you smash it on the door. You might not break the first time. When you hit it like 10 times, it might start to break, right? So maybe like 2 or 3 is okay, but you don't want it to touch it multiple times in a very short time period. That's no good, right? You want to look at the structure, and we'll get into that in a second. But look at the lows, right? Buyers, right? Buyers, right? People are buying into the resistance, building up into it. That's a good sign that it will break out, right? If it runs straight into it, that's no good, right? It's probably not going to break off the first one. But if it slowly builds into it, right? It's building strength. It gets through it. Then more than likely it can get through it. And then remember what happens when it comes back down. We have FOMO bulls, people sitting on the sidelines. They're tight. They missed it the first time. Comes back down to that price, they're probably going to want to get in. The bears who shorted got wrecked when it broke through. They're red. So when it comes back down, they're probably going to want to get out. And yeah, look. So resistance, support, right? Previous resistance turns to support. That is golden, right? You want to look for setups like that. So when Square ever comes back down to 194-ish, 190s, right? People are probably going to want to buy again because they missed it. They missed this, they missed that, right? They're probably going to want to buy again. It's at like 240 right now. So if it drops $50, goes on a discount, people are going to want to buy because they missed out. Or they're going to want to add, because who wouldn't want to buy a stock that's bullish that came back down to a cheaper price? Okay, next, Snowflake. Okay, Snowflake. Again, this is a vice versa, right? Previous support. So previous support, buyers bought it here, right? Buyers bought it here. Then boom, it broke through, right? So what happens when price drops? When people bought it here, now they're red, right? So now they're red. Comes back up. The people who originally bought is finally back at the most recent price that they bought it at. They probably want to get out. And if the bears shorted here and missed this opportunity, it comes back up here, then they're probably going to short or add to their position. Bulls or buyers who originally bought here were red, they're going to get out, and now price has dropped. So previous support has now become resistance. Vice versa, right? Reverse the psychology. Previous support, right? So support. Now this is resistance, right? That's another golden setup. When the previous support becomes resistance, or the previous resistance becomes support, that is a strong area, right? And then what happened? This was in March 2021. This is in March. Now this is July. So that's what? 1, 2, 3, 4 months. 4 months. It finally came back here. What about if the people bought here and couldn't get out? Now they're back here, they're going to sell again, right? They're going to sell. Because it took them 4 months to finally get back to even. Or the bears wanted to short it at 268 area, and they couldn't. So they finally got back, and they're going to short again. Why? Because they think price should go down. Does it matter? Not really, right? You're just looking for the areas where you define as a good opportunity to buy or sell. Okay. Remember, trend is your friend. Okay, you probably heard that before. Pays more to trade in the direction of the trend. Doesn't mean you can't make money going opposite, but I personally am not that good at it. So I personally just like to trade in the direction of the trend. When price fails to make a higher high, right, or lower low, the trend could possibly pause, or it might reverse back to the opposite direction. Identify those area points on a higher time frame. Okay, don't do it on a 5-minute, 15-minute chart. Do it on a monthly, weekly chart first. Those are the major areas. Those are the ones people have big FOMO on, right? People are looking to get in on those areas because they missed out on it, right? And they're more likely stronger because those are more extreme. The more extreme areas are good opportunities once it gets back to that area. Zoom out. Okay, zoom out, meaning go to the weekly, monthly to see the big picture. Says you the overall trend. Remember all the Stocks, we went over here on the monthly chart over a couple years, right? That's where you can tell what the tide is. If you go if you zoom in too far, you don't really know what the tide is, right? You catch the wave. You might see what the waves are, the more intermediate short-term trends that happen every week or two or month, couple months, right? But the long-term trend is what you want to pay attention to. Use volume as an indicator. We'll discuss volume next of how strong a certain move is for a possibility that the price can continue in a certain direction or reverse. Okay. When an asset is trendless, like we saw AMD, right? We saw some other stocks that are trendless. You want to buy support, sell resistance. Right? If it breaks out of that consolidation, it breaks out of the range, you might see an explosive move. Okay. When the previous support, like we just said, previous support becomes resistance or previous resistance becomes support, that is A plus, right? That is a great entry. Only when you get confirmation that it has become, right? It has become a new resistance or a new support. So boom, those are some key tips you want to take away when looking at trends, when looking at support resistance, just so you know what is the direction and where you could possibly get in, where you could possibly get out. Okay. All right. I thought this was a funny quote in the book. Volume is the steam that makes the choo-choo go. So I just threw it in there. So what is volume, right? Volume reflects the activity of the traders and investors that participate on a daily basis. So the daily volume measures the number of shares or contracts, if you're doing options, that are traded in one day. Typically, right, it's plotted as a histogram. And what's a histogram is just a series of bars, right? Bars right under the price. So if you notice, right, the volume is on the bottom. That's the volume. The volume changes on a day-to-day basis, right? So it's showing you how the bulls or the bears are reacting to the price swings. So it can provide a clue as to whether the trend is likely to continue or likely to reverse. So when we talk about high volume, we want it to be about 25% above the average volume. That's high volume, right? Something catalyst happened for the day, something going crazy, high volume. The more people participating. Low volume, kind of slow, kind of choppy, not much going on, right? Just an average day. Low volume is about 25% below the average. And you could just Google what is the average volume, or maybe your broker could tell you what is the average volume of a certain stock. And you'll be able to see, okay, are we above average? Are we below average, right? So high volume confirms trends, right? Rising volume is a good signal for a strong trend, okay? If the volume shrinks, so it starts to reduce while the trend continues, it could be ripe for a reversal. Why? Because it just shows that not as many people are participating in this trend, right? In continuing it. So if not a lot of people are participating, continuing it, then it is right to probably reverse or end or pause, right? On steady volume, you see volume is steadily rising or just steady, right? It's likely to persist. If you're trading breakouts, meaning you're waiting for price to go higher, you're waiting for price to go lower, you want to look for high volume. Why? Because you want to see that a lot of people are participating in this, are buying or are selling. If you see that as confirmation that it can continue in that direction, because you don't want to trade a breakout and it fails. And that happens, right? Not all breakouts are continued. Some breakouts fail. So if some breakouts fail, right, it just means not a lot of people are committed to sending the price higher, sending the price lower. It's going to probably come back to that range, right? So breakouts with high volume, it flushes out the weak hands and is likely to start the new trend. What is the weak hands? The weak hands are people who are likely to just sell or buy off initial reaction. So if you flush out the weak hands and the strong hands, they exchange, right? They exchange the shares and stuff. Then the weak hands may join the strong hands and continue price in the direction. Let's look at some of the charts, right? See, on certain red days or certain green days, the volume on the bottom is high. And what happened after that, right? What happened after those strong volume candles is likely to persist, right? Same thing on square. Look at some of these really, really like strong volume days. Did it continue? Right? And then look on days when it went higher, but you see the volume on the bottom is like getting lower. It looked like it was in reverse or it couldn't continue, right? There's not a lot of people being committed, right? Same thing for AMD. Notice on AMD, some of these days had high volume. And what happened after the high volume day? It was likely to continue, right? And what happened on certain days where the volume was low? If the volume was low on certain days, it kept going higher, it's likely to reverse. So yeah. Look at Apple, rising volume in the beginning of the month shows that the breakout and the trend is likely to continue, right? And look at the most recent days, the volume is steady, right? It's steady, it's high, it's not super low. It means the trend is likely to continue to persist. Roku, right? Roku last month in June had a crazy like 5-day streak on rising volume, right? The volume kept rising higher and higher and higher. But what happened when the volume starts to die down a little bit, right? Roku is now in the like 410s, right? From 460. So people who bought at 460, right? It was a low volume day compared to its run in June. And what happened? Well, people are not as committed to send the price higher, right? So it's likely to reverse. There are some hints, it's clues. Doesn't mean it's going to work all the time, but it's a clue as to could the price continue higher or could the price continue lower. Facebook, remember when Facebook had that one random day and the antitrust case was dismissed and high volume day, right? Well, what happened after that when the volume died down? Well, the volume died down and it's tried to send it higher on lower volume compared to that day. Well, it was likely to fail. Why was it likely to fail? Because there's not a lot of people committed to wanting to send the price higher. S&P, on certain days where there's like, panic, kind of like late June and recently, right? When the dips last Thursday, there's a high volume. A lot of people bought that dip. But what happens when there's high volume, people buy dip, likely to send the price higher. Okay. So just use volume as an indicator, as a tool to give you a clue as to whether the price can continue higher or can reverse, or continue lower or reverse. Okay. And we'll discuss how to use volume more later on in the session. Any questions about trend, support, resistance, volume so far? I know that was a lot. Feel free to ask questions. No question is a bad question. If you're learning this for the first time, I had to read certain books over and over again to kind of understand this. I had to look at a lot of charts to understand this. So feel free to ask questions. Look for more core bodies. Wicks. Oh, the previous question, I'm looking more for like wicks. But if the body is touching a certain support, it means it's spending more time there, right? But usually strong support resistance levels, it's like a quick reaction and that dip gets bought or that, price gets sold very fast. That's a very strong level, right? Okay. It's Mark Douglas, Trading in the Zone. Shout out. Let me know in the chat if you read this book, Trading in the Zone. If you haven't read it, pick it up, read it ASAP. One of the most powerful books, trading psychology out there. Great read. Indicators, yeah, we'll go over that in the end. Finite number of traders participate in the markets on any given day, week, or month. Many of these traders do the same lands of things over and over in their attempt to make money. In other words, individuals develop behavior patterns, right? These behavior patterns are observable and quantifiable, in which we're seeing on the chart. They repeat themselves with statistical reliability, meaning it won't happen 100% of the time the same way, but statistically, it may happen again, right? Technical analysis, like we're discussing, is a method that it organizes this collective behavior into identifiable patterns that can give a clear indication of when there's a greater probability of one thing happening over another. In a sense, it allows you to get into the mind of the market to anticipate what's likely to happen next based on the kind of patterns the market generates at some previous moment. While we're looking at trends, support, resistance, right? We're looking at where does price have a higher probability of going in one direction than another. What happened when it bounced on that support a second time, a third time, right? There's a higher probability that the price may stop there and reverse than it is to continue going lower. At the resistance, right? There's a higher probability that the price will stop and reverse than to continue higher. Okay? Remember, probabilities, not 100%, okay? Nothing works 100% of the time in trading, otherwise everybody be rich. Probabilities odds are more likely, odds are higher than of one event happening than another. Okay. Yeah, Disciplined Trader was his first book. I'm almost done with that, but it was also a good book. So yeah, I haven't read that book. Everyone in the chat says good read. Read it ASAP. More than once. Second time, third time you read it, find new gems. Okay, Candlesticks 101. We've been looking at candles. Some of you guys are probably like, what is going on? So Candlesticks 101, okay? Very simple candlesticks. Another representation of chart reading. If you've been looking at line charts, that's also another way of reading charts. But it only takes the closing price of a time period. But we know throughout the day, price is going up, down, constantly, right? So the candlestick tells you open, high, low, and what the closing price is of that certain time period. It tells you a story, okay? What happened? You know, the price go higher, did it go lower? Where, how high, how low? Where did it open? Where did it close? So you want to choose a time frame to look at a chart. You can look at intraday, right? 4 hour, 1 hour, 30 minute, 15 minute, 5 minute, 1 minute, right? The wicks are the shadows, right? The wicks are like the lines, the thin lines, right? The wicks tell you the highest and lowest. How high did it go? How low did it go? The body, right, tells you where did it open, where did it close. As simple as it can sound, okay? Green is up, red is down. Green means up, red means down. That's it, right? Green candle up, red candle down. This is a representation. Green up, red down, okay? Green means the price closed higher than the open. So Apple opened today 146, closed 149. That's a green candle, right? Tesla opened 660 something and closed at 650, red, right? The closing price is lower than the open as a red. So you want to look at candlesticks and ask yourself, who is in control? Who's in control? Buyers or sellers? Right? Where did the price open and close in relationship to the high and low? It tells you a story of the battle, right? Think about like gang wars, like two gangs going at each other all day long, all week long, all month, all year long. And you want to see who's winning, right? You don't want to be on the losing side of a battle. You want to be on the winning side, right? So you're using candlesticks to give you a clue or indicator of who's in control, who is being more aggressive, okay? So here's like a bunch of patterns, okay? You don't have to memorize every single one of them, but just notice the relationship between how the candles look. Where is the high, where is the low, where is the open, where is the close, right? So we start with the hammers and these patterns, right? Notice how at one point, okay, I'm gonna have to just do some more art. Oops. So this first candle means that price opened here, it went down, and then it went back up. So who's in control, buyers or sellers? If the price is higher than it went down and it came all the way back up. So the buyers bought the dip. Who's in control? The buyers. The buyers are in control. So if the buyers are in control, then there's a high probability that the price will continue higher, right? Two candle patterns, right? Price went down, now price is up. Bullish engulfing. Price went down, but now this candle completely engulfed the other candle. This open and this close, it took over that candle. So if it took over that candle, like today, like for example, yesterday the price went down. Today the price was lower, but it ended up higher than yesterday's high, right? That means the buyers have taken control. If the buyers are taking control, price is likely to continue higher. Next one, price went down strong, right? And now price could not continue to go down, the price could not continue to go up, but the buyers were able to buy up. So if the buyers are able to buy up, likely price can continue higher, right? This one, price went down. Price opened lower than this low. So price opened lower than this low, but closed higher, right? Buyers have taken control. And there's three candle patterns, but you just want to know who's in control, right? What's the probability that the price can go up the next day or the next time period, right? Same thing. Price went up, price came back down. Sellers are in control. It closed red, right? Closed red. So if it closed red, sellers are in control. It went high, but the sellers took over and closed lower than the open. So if it closed lower, then the probability that it's going to go up is not as likely as it is to continue down, right? Think of probabilities, right? And then these candles are just the opposite of the other ones, right? So all in all, you just want to know, okay, who's in control based on the price action. Did the buyers win or did the sellers win, right? That's it. Sitting on the bid ask, what influence supply and demand pressures? Sitting on the bid ask. So bid and ask is just the best available price. So the highest price the buyer is willing to pay or the lowest price the sellers are willing to sell, right? So they're constantly watching that, or if you look at level 2, you see the order book. There's many orders of people buying, many people of orders selling, and they can change their mind about, okay, do I want to bid up or do I want to bid down? Do I want to offer them higher or do I want to offer lower, right? So throughout the day, supply and demand shifts. So if people are willing to bid higher, then they're going to cancel the orders that they have lower so they can pay a higher price. The sellers will have to cancel their orders of selling lower and change it to selling higher, right? And then certain prices have many orders lined up for that one price or less orders for that price. And people can easily get in and get out of these prices, right? Hopefully that answers your question. But all in all, just know in the candlestick, who's in control, who's winning, right? You want to know who's in control. That's it. And it takes practice to kind of watch it, to study it. So just look at a bunch of charts and you'll be able to see these in real time or just study them, right? Try not to memorize, like I said, try not to memorize every pattern, every name for every pattern. It's not the point, right? The patterns could give you an edge where price can continue or reverse based on looking at the candlestick, who's in control. Like I said, pay attention to the relationship between the open, high, low, close. It should tell you who's being more aggressive, and you always want to be on the side who's being more aggressive. And just add it to your toolbox, right? Let's say the bullish engulfing is at a support, right? Or resistance. We have a shooting star at a resistance, right? Things like that. So use it as a trigger, right? Oh, I see this pattern at my support or at my resistance. Then that gives me a trigger or some indicator that I should get in or get out. Time frames, daily better than intraday. It just depends. If you're an intraday trader, I would recommend like the 1 hour chart or the 30-minute chart. 15-minute maybe smallest. Anything smaller, it's hard to tell the direction, right? Because there's a lot of data going up and down. If you're if you're swinging, then weekly, daily, monthly is better, right? It just depends, like who are you and what your style is, right? So if you're a scalper, then you don't pay attention to the daily, weekly chart, watching it in real time, right? You're paying attention to the intraday chart because that's telling you what's happening right now, right? If you're a swing trader, you don't care about what's happening right now. You just care about the open and the close, right? You care about where is it going to open, where is it going to close on a given day or on a given week. So you choose which time frame's better for you. If you're a swing trader, I know Christine, she does the weekly, monthly, and goes on the daily. If you're an intraday trader, you're a scalper, maybe the 1 hour or 30-minute chart is better for you. So it just depends, like what style are you doing? Because then you don't want to pay attention to the wrong time frame. But resistance, support, trends, more weight on the higher time frames. So when you go into intraday time frames, you have it marked off already, and you can know where to get in based on those levels, right? I'll give you a tip. The 1 hour chart gives you really good levels on the intraday. 1 hour. If you go smaller, you get way too many levels, and that's not important, right? It's not going to hold as much weight. The higher time frame you go, those prices hold more weight. Okay, this is also from a book. Popular opinion is nearly unanimous. Contrary thinking tends to be most profitable. The reason is that once the crowd takes a position, it creates a short-term, self-fulfilling prophecy. But when a change occurs, everyone seems to change their mind at once. Crowd, right? Some people say it's bad to follow the crowd. Sometimes when the crowd is being aggressive, it's good to follow the crowd, right? But sometimes when everyone thinks a certain way, maybe contrary thinking could be more profitable. 1 to 2 days swings tops. So if you're doing like overnight or 2-day swings, maybe the daily 4 hour is better. Yeah. Okay, continuation reversal. This is also getting into support resistance trends, kind of digging into a little bit more of the psychology behind these patterns, right? So this is just a very short picture. I have another picture on the next slide, but basically patterns and cycles repeat themselves, right? Why? Because human behavior does not change. So if human behavior does not change, then the markets, they do change, but us humans, we don't really change the way we think, right? So remember, price either uptrend, downtrend, trendless, 3 different directions of the overall trend. If the price is in a trend, sometimes there's patterns that show a reversal happening, kind of like a double top, head and shoulders, rising wedge, or double bottom, inverse, falling wedge. When the price is trendless, there could be patterns that show a continuation. So sometimes it could be the rectangle, the falling wedge, the pennant. Another tip is volume tends to decrease during the consolidation phases, right? Because it's kind of like a tug of war. It's getting tighter and tighter and tighter. Nobody knows who's going to win. And suddenly, like one side just breaks out and takes over, right? So volume tends to decrease. The action tends to get tighter and tighter and tighter, and then eventually it breaks out. And I'll show you guys some charts as to how that happens, right? This is a little bit more intricate of all the patterns there are, but not necessarily all of them. You choose which ones you like the most or want to trade the most. Bullish patterns, the flags, the pennants, cup and handle, ascending triangle, symmetrical, the bearish, the bear flags, pennants, inverted cup and handle, descending triangles, symmetrical, measure move down, all that. Reversal, the double bottoms, the tops, the head and shoulders. So these are patterns you want to look for on a higher time frame. Okay, those hold more weight. You can do it on an intraday time frame. You can't. If you're doing it on an intraday time frame, then you're looking to get in and get out on the same day. If you're looking on a higher time frame, that's more like a swing. But always higher time frames, right? They'll hold more weight because they're most obvious. They're more obvious and they've been happening for a longer period of time. So if the pattern's happening for a longer period of time, then it's more obvious to see. And if it's more obvious to see and it's happening for a longer time, then the next move is going to be pretty big compared to an intraday. If you're doing it on an intraday pattern, then the move might not be as big as it were to be on a larger time frame. So I'll show you guys what I mean on the next slide. But you could use it as a strategy. You want to wait for a breakout or reversal to actually happen, right? You want to wait for it to happen first as a confirmation. You can get in before, but if you get in before, there's no way of telling that that pattern is actually going to work out. You could also entry on the retest. So it reversed and it comes back, right? Kind of like previous resistance turned to support, support turned to resistance. It can come back. And if it comes back, that's another way of entering there. You want to identify where is the high and low support resistance above and below the pattern so that you know where you want to exit. You can also measure the distance of the base of the pattern to the breakout for a price target. That's another way to get a price target. Now, one thing is not all of them are guaranteed to work 100% of the time, right? Sometimes, remember, it's biased on the way you draw it. So if it's biased on the way you draw it, you might draw it differently than someone else. Someone else, or you're looking at it from a different time frame, is biased, right? Based on how you draw it and how you interpret it. So they're not always going to guarantee to work. Nothing is 100%, remember. Sometimes it's false breakout. Sometimes it looked like it's going to break out and it comes back down and it keeps consolidating, right? Or, some patterns are neutral. So the triangles and the pennants, some of them are more neutral. It could break out in the same direction and continue, or it could break down and reverse, right? So keep that in mind, that not all of them guaranteed to work. Could be false breakouts. Some of the patterns are neutral. But more in all, you want to look at it from a higher time frame if you want to get a bigger like trade out of it. If you're looking at an intraday, then the enter exit is going to be faster. You have to do it the same day, and the target is not going to be as big, right? Okay, so Facebook last year, if you guys remember the run up around this time last year, we see a little double top, right? See a little double top, right? And what happens when this neckline breaks, right? It breaks, then it reverses. tried to come back, and it kept going down and down and down, right? So you measure this move right here, you measure that, and you make it here. That could be one target off this break. So it broke 290, and then went to 277, but it kept going down to like 242. So that's one example of a reversal pattern. This is on the daily time frame, right? Notice how the volume got low during this reversal, and once it broke, the volume increased. Right? So yeah, I don't know if anyone remembers this from last week, but this happened. This is a clean double top, right? Very clean. Okay. Next, we have Amazon. So Amazon is like a rectangle, right? It's just been resistance. Resistance is the weekly chart. Resistance, support, 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 right? And what happens? This is from July 2020 to July 2021. 1 year of consolidation, right? Then boom, we get an explosive move. It went from 35.49 to this is like 37.60. It's like $200 worth of move, right? So the longer it consolidates, yeah, the longer it consolidates, the more explosive the move could be, right? And people are waiting. And obviously, this is so obvious, right? This is so obvious to everyone. Everyone's been waiting for this. So that's why on the higher time frames, it holds more weights. Okay. Apple. So this is like a ascending triangle, right? Apple. Technically, if you measure this move, 138 to about 105, this is 30 plus 30. So it goes plus 30 from here. You can go to like 168 theoretically. Okay, I'm not saying it will go there, but it could go there, right? So you notice how you have higher lows building up into the resistance, right? We had one false break and it came right back down. Then boom, it finally broke. And it went from 138 to today 149, $10, right? From a weekly on Amazon, you enter after it broke that level or wait for a retest. First break is a good entry because what if you wait for the retest and it never happens, right? But if it does retest, think about people that didn't get in the first time. They're going to want to get in, right? So when you're trading like patterns like this, you want to see, right, or ascending triangles, you want to see buildups into the resistance. This means the buyers are getting stronger, are willing to pay higher for the price, so that eventually they're going to squeeze these sellers out of their positions. And people who are originally short may flip to the buy side, right? First break, daily, depends what time frame. It could be daily, weekly, monthly, intraday, right? The measure move. Okay, yeah, measure move. If you're doing triangles, you want to take the first swing. So the first swing of this move would be from here to here. You take that measured move, you add it to the breakout level, and that is your target, right? If you're getting something that's like a pennant, and you take this move right here, you add it to this move, and that's your target. If you're looking at double top, right? You take this move right here, and then you measure it, and then you add it to the breakout, and that's your target. If you're looking at bull flags, right? Same thing. If you're looking at bull flags, and you take this move right here, right? And then you add it to this move, to this breakout point, and that's your target. So yeah. And then Tesla, this could also be like a double top on Tesla, right? So Tesla, you measure that move, right? From here to here, you add it to here, and that's your target if it breaks this, right? Tesla ran crazy, kind of showed like a triple top, almost double top, triple top, right? And then finally broke, and boom. And look at the retest, right? Came back. What happened? Same thing, right? Yeah, originally the measure move went from 778 to 765, but it kept going lower, right? So you can never catch the top or the bottom, take every dollar off the table, but just know it's possible, right? And that's the power of having runners or just holding your positions. Okay, so that kind of just shows how to trade some of these patterns. You can just know what the pattern is, how it's being set up. Look for them on a higher time frame if you want them to hold more weight. If you want it to go on an intraday time frame, that's fine too. But just know that your exit is going to be in that intraday, right? Another thing, you can see this little pennant looking thing, right? And then eventually it broke out, right? You see this pennant, take this move, and then you add it here, right? Did it get all the way there? No, right? But people also traded that, right? So, boom. And then last one, Tesla again. This was after the stock split. Remember, September, everybody got clapped. I did too. But pennant, it consolidated from September to almost December, and then that was like the S&P news, right? And it was going to get added to the S&P. So you take this measured move from this swing high to low, you add it to your breakout, and that is your first target, right? On the H pattern, if it's going like this, looking for that, it will probably be from here to here. You measure the N part of the H, right? I believe there, and then you add it and you go down here. Right? Add it meaning, okay, let's say this was from theoretically 500 to 350, that's 150. So if that's 150 and you're looking for it to break out here at 450, then you're looking to get out at like 600. So let's say, I have no idea what the exact price is because I kind of just drew the arrow, copied and pasted. But this was 570, and let's say the price, the move was 150. So if the move was 150, then this breakout would have been like 420-ish. So 420 plus 150, that would be your move, your measured move, right? So yeah, it takes a little bit of math, but not very too complicated. But the measured move would be your first target, right? Is it guaranteed to hit it? Not always, but can it hit it? Yes. Can it go higher or can it go lower? Yes, right? Remember, anything can happen, right? Anything can happen. Okay, another quote from another book: knowing others is wisdom, knowing yourself is enlightenment, mastering others requires force, mastering self needs strength. By Lao Tzu. Yeah. Okay. Indicators. I think you guys are excited about this part. Or somebody asked about indicators. So we're going to get into indicators. Okay. Now, before I get into indicators, just know that this is still not the holy grail. Nothing we discuss is the holy grail, right? It just simply can give you an edge. It can help you identify good setups, right? Is it going to work 100% of the time? Absolutely not, because then everybody would be rich trading all this stuff, right? But it depends how you interpret it and how you use it to your advantage, right? And you have to be very flexible with whatever happens, right? Okay, what are indicators? Simply, the most bare basic definition of what a technical indicator is basically a mathematical formula applied to price, time, and sometimes volume, okay? Some indicators have volume in it, but not all of them. Like VWAP. VWAP literally starts with volume. So it calculates volume part of it. But other indicators like moving averages and oscillators don't have volume in it. Now they're computerized, right? You just literally go on your broker, you click the indicator, boom, it pops up in the chart. Think about back in the 70s, they used to have to calculate it and draw it on the chart, right? So it gives you unbiased data because it literally takes the data that was already happened and it computerizes it, calculates it, and it gives you the new data, new interpretation, right? Remember the diagonal lines we draw on those things are physically drawn. So it could be more biased, right? We're biased towards how we draw it, how we interpret it. The indicator is more objective because that's just the data. How you interpret it is up to you, right? Based on the market structure, indicators can help you identify the trend and identify reversals. Some work well in trending markets, some work well in flat markets. We'll get into that in a second. Okay. Different types, okay? So 3 types. Oscillators. What is an oscillator? Oscillator helps you identify the turning points, right? It includes like the MACD histogram, the stochastics, the RSI. Sometimes they're more leading that turn ahead of prices, right? Those basically tell you, is it too high or is it too low? Where could it reverse? Trend following indicator. Those are more lagging because price has to happen first, right? They turn after the trends reverse. And it serves more as a confirmation of the direction of the trend. So those are like moving averages, your MACD lines, and OBV, which stands for on balance volume, right? They follow the trend of the stock, but remember, where does the trend come from? It comes from price. So price has to happen first, then the formula takes the price and puts it in the formula and gives you the new price, right? And the miscellaneous, these are like more like the intensity of the bullish or bearish camps, like how intense, how bullish or bearish the market is, and could be leading indicators. So like the put call ratio, you guys know about that, like fear and greed index, new high, new low index, right? These are some indicators that kind of give you an insight of how bullish or how bearish the market is. Moving average, math nerd. So simple moving average takes the price, you add up all the prices up until the number of prices you choose the moving average to calculate, and divide that by the number of days. That gives you the moving average price. So a 50-day moving average, you take the last 50 days closing price and you divide that by 50, and that gives you the moving average. Now it moves. Why does it move? Because price drops off, new price comes back, right? New price is added to the formula. So it moves along with the price, right? So it reflects the average value. It identifies the direction of the mass inertia, like where is the direction of the entire price of the market is going towards. The direction of the slope of the moving average shows whether the crowd, right, is being more bullish or more bearish, more optimistic, more pessimistic, right? Simple versus exponential. So sometimes you guys see like 50 MA or 50 EMA. What's the difference, right? Simple moving average change when the old price is dropped off, new price is recorded, right? Exponential, which is the E, right? Exponential assigns greater weight, okay, greater weight to the last trading day or the more recent price action, because the latest mood of the crowd is more important and the old prices slowly fade away. Does it matter what happened last year? Yes, it matters, but to what extent if we're caring about what happened yesterday, right? The more recent mood of what's happening more recently is more important to the next day than what happened a year ago, right? So exponential moving average formula, price today times K plus EMA price of yesterday times 1 minus K. You're probably like, yo, Nick, what are you talking about, bro? I'm not calculating that. But K stands for N2 divided by N plus 1. N is the number of days in EMA, so let's say the 50 day. So K would be 2 divided by 50 plus 1, right? Price today is literally today's price. And EMA yesterday is what the EMA's price was yesterday. So basically, you don't really need to know the formula, but just so you know that this basically gives more weight to the more recent price data, okay? So price today and what the EMA's price was yesterday is being calculated as compared, more heavily calculated than what the previous 50 days were in a simple moving average, okay? So you don't really need to know the exact formula, but just to show you, right, that the price of the more recent data is being more heavily weighted, okay? So you choose the length, you choose, okay? Narrow, less days it measures, right, makes it more sensitive to the price changes and more prone to whipsaws because you don't have a lot of data to calculate from. But it does catches new trends sooner, right? It does catches new reversals and stuff like that sooner. The wider window, okay, produces less whipsaws, right? But it misses turning points by a wider margin. Okay, so the slower moving averages are not as prone to false signals. The faster ones are more prone to false signals, right? That's basically what it's telling you. How to use it? Okay, price above EMA or MA, generally bullish. Price below it, bearish. Okay, simple. Why? Because if the average prices of the past 200 days is above the current price, right? The price is now lower and is bearish. But if the price of the past 200 days averaged is lower than the current price, then it's bullish. So if it's a rising EMA, you want to buy the dip. So if you look at the uptrend and you see the moving average and is rising up with it, you can buy either the breakout when it gets through it, or you can buy it when it dips and bounces off of it, okay? Now it's a dynamic area of support. Why is it dynamic? It's not a real price, right? It's a formula applied to the price. So it's not a real price, it's a value, right? There's no magic number to use. Some people use 5, 10, 15, 20, 18, 21, 30, 50, 100, 120, 140, 200, 400, right? There's no magic number, okay? If you're on a short-term trend, you want to use anywhere from 10 to 30. No less than 8, because then you get a lot of false signals, right? So some people use like the 9, some people use the 8, some people use 13, 14. I use 14. Some use 21, 26, right? It just depends what numbers you decide. Long-term trend, more so a couple of days, months, right? You want to use a bigger number, 50, 100, 200, right? Because you want to capture the longer-term trend. If it's a falling EMA, sell the rallies. So downtrend, you sell when it pops up, you sell it, or you buy puts, right? You sell it when it breaks down the EMA, it crosses below it, right? Or when it rallies and rejects the EMA. I'll show you guys a chart to see what I'm talking about. If you're using two EMA, two moving averages, right? Keep the ratio between them like 2 to 1. So like 13, 26, 50, 100, right? The value zone exists between the EMAs. What is the value zone? Well, you want to buy things for value. You don't want to pay too much, or you don't want to pay too low, or you want to buy things for what you could desire as a fair value. Now, if you're using a dual EMA, the value zone exists between the EMAs. I'll show you a chart that shows that exactly what I'm talking about. Flat EMA going sideways, don't trade. Why? Because the moving average is a trend follower. If there's no trend, then you can't use the moving average that well. Now, it doesn't work that well in a flat market, right? It's a range bound. There's no trend. Apple, okay, look. Falling EMA, price bearish, you can sell. Price retests that falling EMA, now resistance, entry. Next one, price cross up above the EMA, entry. Now price is above EMA, trend is up, moving average is rising, price falls and bounce off EMA, entry, right? So two ways you could use it. You either use it as a dynamic area of support resistance, or you trade the break through it. You break up, break down the EMA, you take it. That's your signal, right? Next one, Roku, 13 and 26 EMA. 13 is the one above it, 26 is the white one, right? 13 crossed below the 26, bearish. So faster is crossover, slower down, bearish. That's a sell signal. Now, 13 EMA cross above 26, bullish, right? Cross back above. So you want to take it either at the crossover as a signal, or you want to take it as it breaks through, right? Do I trade with indicators? Yeah, I just have the EMA on. I really just focus on the price and stuff. But I'll show you other indicators that you can use too, not just these ones. Microsoft, 1326 EMA value zone, right? The space in between it can be determined as the value zone. So you can literally buy it in between the indicators, right? It's a value zone. And look what happened, right? Now Microsoft 280, 283, right? Boom. Okay, MACD lines. MACD, everybody knows about MACD probably, right? Or everybody has it. So if you don't know what the MACD line is, MACD stands for moving average convergence divergence. Okay, convergence divergence, right? First two lines, MACD line and the signal line. Okay, MACD line is the 26 EMA subtract by the 12 EMA. Signal line, you take that MACD line and you calculate the 9 EMA of it. So the MACD responds faster, the MACD line, right? The MACD line is faster, responds faster to the prices. The signal line is smooths the MACD line with another EMA. So it's slower, right? So you have one fast, one slow, kind of like the dual EMA, right? But this time it's an actual built-in indicator. You don't have to do none of that math, right? So the crossover identified a change in the market tide. Remember, the tide is a trend, right? Go with the flow, okay? Cross over to the upside, that's a buy signal. You want to place a stop below the previous low. Cross over to the downside, that's a sell signal. Place stop above the previous high. Market psychology, right? It defines a shift in the balance of power between the bulls and the bears. If the bulls become more aggressive, what happens? The bulls win. Well, what happens when the bulls win and the price goes up? Fast cross below the slow, right? Bears dominate. What happens when the Bears dominate and they win? Price goes lower, right? So real quick, look at Roku, MACD lines, fast cross below the slow. Look at the arrows, down, right? Sell signal. And then recently, right? This is recent. This is on the weekly time frame. Remember, higher time frame holds more weight. You get less signals, but they may be more powerful. Recently, crossover. Look at the arrows. What happened? Oops. Price goes up. Crazy, right? Okay. MACD histogram. Okay, histogram is remember, the histogram is a series of bars. Okay, it's a type of chart, histogram. So the MACD histogram literally is the MACD line, the value of it subtracted by the signal line. So if the MACD line is higher than the signal line, right, that means the MACD histogram is positive. If the MACD line is lower than the signal line, then the MACD histogram is negative. So basically it's plotted zero, above or below zero, okay? The spread of the lines. So if the spread of the lines get wider, then the histograms goes more deeper or higher. If the spread gets thinner, then the histogram goes lower, closer back to the zero line. So you want to look at the slope of the bars. Slope of the bars, of is it getting high? Is the bars getting higher or the bars getting lower? Now the market psychology behind that, right? The slope identifies a dominant market group, right? If it's rising slope, the bulls are becoming stronger. If it's falling, the bears are becoming stronger. You always want to know who's stronger or who's in control. So let's look at a flick real quick of the chart. Look at Apple weekly time frame. After the March dip, right? Things started to come back alive. Look at the MACD histogram. The bar is getting more shallow, getting closer back to the zero, is rising. So what happens when it's rising? The bulls are getting more dominant. Bulls are getting more dominant, you want to go long. What happened after that? MACD crossover lines to the upside, right? And then boom, over here, right? The arrows show that the MACD histogram is getting more shallow. It's getting closer back to the zero line. What happened after that? MACD lines crossover to the downside. What happened to Apple? It fell during that September period, right? From like 130 to 110. Okay. All right. Oscillators. Oscillators help identify emotional extremes. Okay. Investors are either greedy or fearful in some degree. Two emotions. Greedy, they want it now, they're going to buy. Fearful, they're scared, they're going to sell. So the intensity of greed and fear will surge, go high, and then sizzle, right? So the oscillators help identify the unsustainable levels of greed and fear. Now that brings us to overbought versus oversold. Overbought, right? Market is technically too high. It's too high, it's ready to reverse, turn down, or pull back. Oversold, the market is too low, ready to turn back up, right? It's associated with previous lows of the oscillator. It works well in flat markets. It doesn't work very well in trending markets. Because remember, trending markets, prices going in that direction. Trend can just keep going, right? Who cares if it's overbought? It can keep going, right? But sometimes when it gets to an extreme, right, then it can reverse. But it can give you false signals, right? So it works well in flat markets, does not really work too well in trending markets, but we'll discuss divergences in just a second, and that's you can use that in trending markets to identify turning points. Okay. So RSI, everybody knows RSI, right? People heard of RSI, use it. People don't know RSI. Let's break it down. RSI formula: 100 minus 100 divided by 1 plus RS. RS is relative strength. Now, relative strength is not the same as relative strength of a stock. It's not the same. Relative strength of a stock is how well it's performing compared to the overall market. In this case, in this formula, RS, relative strength, is basically the average of net up closing change for select period of days divided by the net down closing change for the same number of days. So usually RSI default is 14 periods, right? So within the past 14 periods, you see, okay, are there more days where the market has gone up than the market has gone down, right? That's basically what it's measuring. So this helps identify tops and bottoms. So when it reaches the peaks and turns down on the RSI, it identifies the top. Reaches the valley and turns up, identifies the bottom. It fluctuates between 0 and 100, right? So you want to mark off the reference points for extreme highs and lows of the RSI to identify extreme levels of overbought, oversold. So default usually is 70-30. I think 80-20 is more extreme. 95-5 is like super extreme. That's like a crazy signal, right? Now the mass psychology. So the closing price represents the most important consensus of the day. Where did the market close for the day, right? If the market closed higher, then the bulls win, the bears lose. If the market closed lower, the bulls lose, the bears win. So you want to see over the past X amount of days, right? Has the market closed higher than it has closed lower, right? Okay, SPY weekly. Remember the COVID crash, right? Crazy. It went from like 300s to 200. That was a very tough drop to go through, right? But RSI hit 20 on that bottom and it turned back up. That's oversold, right? So if it's oversold, it hit 20 on the weekly time frame. Remember, higher time frame is king or queen, right? That's oversold. That gives you a buy signal because the market has dropped really hard. In the past 4 weeks, it went down compared to up, right? So it's extremely oversold. What happens when extremely oversold? Identifies a bottom, you can buy there. Next one, Tesla. Remember before COVID crash, this is pre-split. So pre-split, Tesla was at like 900. It ran up crazy. The RSI on the weekly was 94, right? That's extremely high. Extremely hot, very overbought. It spent 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks up, right? That's extremely overbought. So that identifies the top, and that's a sell signal, right? It reached that valley and it came down on the RSI. That's a sell signal. So divergence. Okay, we're gonna go over divergence now. So divergence works a little bit better on the trending market with the RSI on the oscillators, right? When the price makes a new high or low, okay, first figure that out. Is price is going to make a new high or new low? The price is primary because remember, all these indicators are derived from the price. There's a mathematical formula applied to the price, right? But the oscillator makes a lower high or a higher low, right? Look at the chart, right? Higher high, but the oscillator makes a lower high, or lower low, and the oscillator makes a higher low. This shows that the trend is weakening, right? It's running out of steam. Now on the MACD, it must drop back to 0 and then create the lower high or higher low. And if you see this on a higher time frame, remember, it gives you a powerful signal. Okay? So look at Apple. Remember, Apple ran up crazy after the stock split. Well, look at the RSI. It was a higher high on the price, but a lower high on the RSI. That's a divergence. Two things don't agree. And what happened after that? The price dropped, right? NOW, I just found this randomly. Right? I was screening through stocks. But look at the price making a lower low, slightly not too hard, right? But the MACD histogram is making a higher low. That's a buy signal. And then what happened after that, right? NOW went up. Okay, so this divergence. We look for divergence when two things don't agree. Then that's a signal. Okay. All right. Quote, trends become more apparent as you step further away from the chart. Remember, you look at a stock, you want to know what the trend is in 10 seconds. Surprise makes prices move, right? I think we all can agree to that. We had after hours news of Netflix. Surprise, Netflix getting into video games. Price goes up, right? So Ed Seykota, Market Wizards. Y'all read this book, Market Wizards? Great book. Interviews of one of the top traders back in the day. Pick that one up. Trust me, you're gonna like it. Okay. Planning trades. Okay, we're getting towards the end. I know it's been a long session. What time is it? It's like 8:30. Okay, it's only been an hour and a half. All right. How you guys enjoyed the session? Maybe y'all learned a lot. Let me know in the chat. What do y'all think? I've been talking a lot, so I kind of just want to get to know how y'all feeling. There's a lot of information. And afterwards, you have questions and want to look through stocks with these indicators, you can do that. But do you have any questions or anything like that so far? It took me a long time to put together. So I hope you guys are like picking new things up and, taking down these notes or screenshotting the slides and stuff like that. I appreciate y'all. This will be up for replay too. So if you want to catch a certain slide or a certain part when me explaining something, yeah. Appreciate y'all. Help clarify a lot. Hey, this is for y'all. You know, I read a lot of books and looked through mad charts, and you know, I want to make sure you guys are well equipped, right? I don't want y'all going through this market and you know making random decisions or you know winging it. You know what I mean? I'd rather you guys be informed and be educated so you can take this information. And hey, you got a friend that don't know how to read a chart? Boom, teach them how to read the chart. VWAP, yeah, VWAP is a really good indicator. Price above VWAP bullish, price below VWAP bearish. But low key, the firms like to buy when the price is below VWAP and sell it when it gets back above. So VWAP is like a moving average, but it's daily because it measures daily volume. So VWAP includes the volume into the average price of like the average number of shares being traded. And VWAP cross, yeah, that's like a dual EMA. So 9 EMA cross above the VWAP, that's bullish. 9 EMA cross below the VWAP, that's bearish. Remember, 9 EMA is a fast EMA. So it hugs the price very closely. It reacts very sensitive. So it crossed above, bullish, cross below, bearish. Signal, right? But remember, that crossover may happen after the price has already gone in that direction. Okay? But that gives you confirmation. Boom, cross up, boom, cross down. Excellent. I'm already positioned to profit, right? Measure moves, yeah, I got that from a book. I didn't even know that was a thing. But yeah, that one's dope. But if you look at Christine's charts, whenever she does the strat and patterns and stuff like that, she always does the measure move. Higher time frames for the patterns, yeah. I mean, higher time frames are always better because remember the signals are more powerful, right? If you go in a lower time frame, the signals are not as powerful, but they still work, right? They still work. But the targets, right, are you're gonna intraday. I read Technical Analysis of the Financial Markets by John J. something. I forgot his name. But I'll give you guys that book. It's a long book, kind of boring, but it gives you a lot of information. Technical Analysis Explained by Martin J. Pring. That one's a little better. Yeah. Okay, planning your trades. Okay, this is how you plan your trades. First, zoom out. What's the trend? Okay, what is the trend? You should automatically know what's the trend. Okay, uptrend, downtrend, range bound. What is the trend? That tells you how to trade, right? If this is an uptrend, you want to either buy the dips or buy the breakouts. If it's in the downtrend, you want to sell the breakdowns or sell the rallies, right? If it's range bound, you want to buy support, sell resistance. That tells you how to trade it, right? So if you know the structure, then now you identify the major support resistance. Okay, start from 1 month, start from the big ones. That's the extreme highs and lows, right? So if it ever gets back there, what do you think is gonna happen again? Is people gonna want to get in or add, right? Then you move down to 1 week, right? And then 1 day if necessary, 1 hour for intraday. If you're an intraday trader, 1 hour is really good. Okay. We'll look through some charts later and show you like 1 hour is really good for intraday. If you're a swing, then 1 month, 1 week better, right? Daily, also good. But if you have 1 month, 1 week, you'll see on the intraday, on the 1 day, not much added to it. You'll get too many lines. Don't clog your chart up, okay? And keep it simple. Identify your entry. Where is the entry? Okay, if you're in an uptrend, where is the support that you want to buy? Where is the resistance you want to sell, right? Where is it? Where do you want to get it? Intraday, same thing, right? Then what is the trigger? Okay, are you looking for it to break through it, break down it, bounce, reject, right? What needs to happen first, right? Because remember, when you're looking at it from the past, it already happens easy, right? Oh yeah, I could just buy here and sell. No, it already happens, so you don't have to react to it. But you're trading on the right side of the screen, intraday. You don't know what's going to happen next. So you need to see what is going to happen and then you take a trade, right? You're looking for a bounce. Okay, it literally has to calm down and come back up. That's your bounce. Reject, go up, come back down, right? Break through, it breaks through it, right? Break down, it breaks down it. So you need to know what's the trigger. What needs to happen? Or you look for a candlestick pattern, bullish engulfing, camera, shooter, right? Harami, cloud, whatever, white soldiers, black crows, right? What needs to happen? What's the trigger? Okay. Now, stop loss, price target. Okay. Price target, profit targets, PT, TP, all the same thing, right? Do like 1 to 3. Okay. 1 to 3 targets. So if you get out at the first one, it can go higher. Okay. If it can go higher, then you have 2 more, right? and then stop. Okay, you need to know, okay, if it breaks under this or it goes higher than this, then this setup is donezo. It's not gonna work, right? The probability of it working out is so low that it's not worth my money, right? So you don't want to hold it past that level. Okay. Is invalid, right? It's not gonna work out anymore. You have to like let it go, right? Remember, nothing's 100%. Things can fail. Things don't work out. Just let it go, right? Okay. All right, and then also to add to this indicator, use the moving average, use MACD, RSI, VWAP, Bollinger Bands. We didn't discuss that, like fibs, anything, right? Is there a signal, right? Is there a buy or sell signal? Is there more confirmation, right? You want confluence. You want a lot of different things telling you the same thing as agreeing with each other. Now, that's very obvious. That's very powerful, right? So yeah, indicators. If you're gonna add indicator to the chart, then decide what is good to pair with what, right? Okay, and what works well, right? If it's a flat market, you don't want to use moving average flat market. If it's trending market, you can use your oscillators, but make sure you don't get false signals, right? You know what I mean? Okay. All right. Now, one key tip, okay? Your edge, your strategy, it needs to work for you. Okay, you just can't copy someone else's or copy mine or copy Hunter's or Christine's or Seven's or Chef Money, right? You need to know what works for you. Okay, what works for you? What are you comfortable with? What makes sense, right? What do you understand? Don't try things too complicated. Not worth it, right? It's your money on the line. You're trying to profit, right? Find out what works for you. What are you comfortable with? You day trader, you swing trader, right? Figure you need to understand yourself. What are you comfortable with? What do you like to do? And then pick one. Okay. Worst thing I could have done last year, I had like 5 different ways. Now, if you have 5 different ways, it's okay. You're more versatile, but you can't master all 5 at once, right? You pick one, you get really, really good at it, and don't do anything unless that one strategy presents itself. Then you get really good at it. Now you add more to the toolbox, right? You try too many different things at once, you're gonna get varied results, right? You're gonna look at your trading journal data, and you don't have consistent results. It's not worth it. It doesn't make sense to you, right? You're not get reliable results. You're not gonna see improvement if you try the mad different ways, and you don't really see real improvement. You pick one way, you stick to it, you get really good at it, and then boom, there you go. That's your way, right? High risk to reward ratio. We didn't get to discuss that because we're really just going over technicals. A high risk to reward ratio, you want to make sure you're making more than you're willing to lose. So Apple was at 149. It needs to go to 155 for me to make profit, and I'm only willing to risk $1 if it goes down below 148 for me to take this trade, for example. Right? Why? Because you want your reward to always be higher than your risk. Why would you take a trade where you're willing to lose more than you make? That makes no sense, right? Now, if you lose, it's okay because the higher big wins will pay for the losers. They pay for it, right? Think losing, okay, losing normal, okay. Type L in the chat. You took an L today, this month, this week, right? Losing is completely normal, right? I lost a couple times. Everybody loses, right? But losing is an expense to finding a winning trade. Think about it that way, okay? So you got to spend some money to figure out whether you're going to be right, whether or not it's going to make money. Now, are you willing to spend a lot of money? No, spend a little bit of money, right? You spend a little bit of money, then you lose 5 times in a row. It's okay. Well, psychologically, it could be defeating to lose 5 times in a row, but overall, you're not going to lose a lot if you lose a little bit. Then you find a big win, home run, grand slam, right? It pays for all 5 losers. That's it, right? So have a high risk to reward, offset the losing trades. Those losing trades doesn't matter because you hit a home run, right? Combine the technicals like we just discussed with the fundamentals. Because remember, the only reason why price goes up or down is because people want to buy it or people want to sell it really badly, really aggressively, right? So combine that with fundamentals. News drives people to want to do things, right? But sometimes price moves, breakout is there. You take 5 minutes searching through the apps to find news to back it up. Price already left without you, right? So sometimes You don't need the news to figure out why it's doing this. It'll come out later. But think about it. The minute news comes out, all these institutions and the high frequency traders have access to the information and they're already on it. Then you see the price goes up and you don't get the news until like 5 minutes later and the price is already gone, right? So combine the fundamentals and the technicals, combine it, high conviction, right? Boom. Like, was it Disney last week? Great box office weekend, right? And the upgrade. Boom, it goes $6. Great, right? Okay. And Apple's been doing fantastic. We know Apple makes a lot of money, so it's been long overdue. And they want 20% more iPhones because they're going to sell 90 million iPhones. 90 million iPhones times $1,000 an iPhone. 9 billion, right? Price is going to go up. Why? Because Apple's about to make a ton of money, right? Every moment in the market is unique, okay? What happened yesterday? What happened a month ago, last year, 2 months, 6 months ago? It's not going to happen the same way. Why? Because different people have different opinions. They change their opinions, right? Or a different number of participants, different types of participants, right? Just because this is the support doesn't mean today is going to hold the support. Today it could break the support, right? So every market is unique. Anything can happen, right? So just be very flexible with the outcome of your trades or outcome of the market. Be flexible. Be very strict with your plan, with your rules, with how you get in. Be disciplined, like we said in the beginning. The Marines, right? They're all disciplined. All right, strict risk management. Okay, it's very short. Position size. Make sure you're not trading a big position too big that you're not comfortable with it. My rule is no sweaty pits. Okay, don't be sweating while you're trading. That means you're uncomfortable. That means you're anxious, and you're not ready for that. Right? Trade one contract's okay. You can't handle 5, then just trade 1. Right? Work your way up. Predefine, accept the risk. Okay, you say I'm only willing to lose $200. Okay, I'm only gonna buy this much, right? And if I lose the 200, so down so be it. I already am comfortable. I already defined that I'm okay with it. I'm accepting it, right? And keeping what you created, right? If you make $1,000, don't just put $1,000 back in, right? Keep like 600, 700 of it. Risk 200, risk 300. I tell Alberto this all the time, right? You're up 1,000, and don't put $1,000 in. Put in a little bit at a time, right? Keep all the profit you got. You give it back. It's okay to give it back, but don't give back everything. Right? Be willing to let go. Okay, sometimes things don't work out. It's fine. Not everything works out 100% of the time. You hit 10 in a row. The 11th one could be a loser. It's fine. You have your exit strategy. You have your stop. You know how much you're willing to lose. Sometimes things are out of your control. Sometimes it gaps up, gaps down overnight, or things happen. News, right? Fed, elections, or disaster. Like, it happens. It's okay, right? Be willing to let go, because you hold a losing position. The only thing it's going to do is lose more. At a certain point, you're going to have to let go. Could it reverse back even and go higher? Yes, it can, right? But does it happen all the time? Not really, right? Make yourself available. What I mean by that, okay? Every single day, there's opportunities on every time frame, every stock, right? Something's moving up and down. You have nothing to prove to the markets, right? As you yourself behind your screen executing your orders, right? The markets will give you the opportunities. You have to take. You have to be open to taking them. For example, Tesla today, I thought it was going to break out. It tapped the breakout, reversed back down. Well, if you're originally long, you have to be open about reversing, or open to um, take the opportunity that you can short or you can sell by puts, right? For example. Now, if you're closing your perspective on being able to do that, then you're missing out on the opportunity. Okay, it's giving you an opportunity, but how you interpret the information will define will define your definition of opportunity. Right. So just let the market do what it does, and you take the information and define your opportunity. All right. Cool beans. Research studying 2 books. One is The New Trading for a Living by Alexander Elder. That was a really good one. Highly recommend that one. He's a psychologist, a psychiatrist, works in psychology, and he trades for a living, right? So he'll tell you certain things and how you want to become a pro trader. Training the Zone, Mark Douglas. We all kind of gave our testimonials. Great read. Read it more than once, twice, 3 times. I listen to an Audible on Sundays, but before the open for the week, so I can, remember some of the things I need to know. Master that Ian Dunlap. I learned a lot from that guy. He's been in this for a long time, so he knows a lot of his stuff. Rainer Teo, the guy's from my dad's country, from Singapore, but he used to be a prop firm trader, and I watched a lot of his videos on YouTube on the technical analysis stuff and how to use indicators. He's very knowledgeable on that stuff. He trades more like Forex mainly, but yeah, big ups to Singapore. Yeah, he trades Forex mainly, but trading works on all markets, right? Commodities, futures, Forex, stocks, bonds, right? Same thing, right? TradingView, I use TradingView for all the charts I posted y'all. TrendSpider is another platform I found. You have to pay for that, so you don't want to pay for it. You don't have to. Just choose another platform. If you're on Webull or TOS on your brokers, they have charting tools. Use that. Stock charts. Hunter, I know you use that. And bar chart. It's also a good one. So find a platform where you're comfortable with learning how to chart and use it. Some you don't have to pay for, some you have to pay for. If you have a broker that has it with it, then you don't have to pay for another service to chart. Use your brokers. Okay? And last but not least, your success will not happen overnight. It took me a long time to learn a lot of this stuff, and there's still more for me to learn. Do I use the paid version? Yeah, I dropped I think 100 something last Black Friday for the year, and you get multiple charts on your screens, mad indicators if you need it, alerts, and all that stuff. And real-time data too, that was really important. Build discipline, read, study 2 hours a day, learn, watch the market, make it a habit, right? Find your winning strategy, find your edge, practice. Okay, if you just went through this and it looks good, sounds good, but you haven't done it before, practice, right? It doesn't matter, just practice. Paper trade, right? Small size, if you don't want to practice, take very small trades with your real money. And try 20, 100, 300. Prove to yourself you can do this, and then go ahead, right? That's your strategy. Stick to it, right? It's like trying to deviate from what you're already good at and doing other things, getting distracted by the noise, other people's opinions, people on Twitter, like FinTwiz, StockTwits, right? Other people's opinions, right? Don't get caught up in that, right? CNBC be talking crazy sometimes. Like, stick to your opinion and your analysis, your plan, and don't let other people's opinions sway yours. Like, one thing I learned is never, if you have an opinion about something and this is your analysis, don't let someone else's opinion cause you to be like, oh, you're right, I'm wrong, right? No one's right or wrong. The market is right. Okay? The market is right. The market will tell you whether you're right or wrong, right? And then stay in the game for as long as possible. We had meme stocks, the SPCE move, AMC, Tesla, Amazon, Nvidia, Roku, Apple recently, Facebook, right? So many opportunities. But if you blow your capital, you lose all your money, and you can't get in, right? Because you don't have the capital. So survive. It's all about survival. You survive long enough, you get those opportunities. For sure, they happen. Markets are irrational, right? Because people are irrational. They make bad decisions all the time. And the last quote: success demands singleness of purpose. So, write down right now, why are you doing this? Why are you sitting in this session? Why do you want to learn this? Why do you want to get good at this? What is your purpose, right? What is the underlying purpose? For me, I want to make money so I can invest and not have to take it out of my main job paycheck. Also, eventually want to teach kids how to do this, high schoolers. I want to make enough money where I can just tell my parents to stop working, right? So know what your purpose is, right? I want to help people. I want to get people to learn this and get good at this. So know what your purpose is, and that will drive you to work harder and stay true to what you want to do. Right? And yeah, thank you guys for sitting through this. We can go through questions, look at charts for a little bit before the NBA game starts in 10 minutes. But my Instagram, that's my Instagram. Discord, I'm on Discord. You see me on the chats and stuff, watch this. I've been posting my swings recently. If y'all like that, I'll keep doing it. But my ideas and stuff like that. Yeah. One-on-one bookings, I just started that up. Just click the link to book a one-on-one, just to kind of figure out, like, you're having trouble, you've been losing, you've been, just not kind of just having trouble figuring things out and what you're doing. I'm willing to talk to you about it. TTM Squeeze. TTM Squeeze is, I believe it's like an oscillator. Um, I never used it really, but I know it's kind of like MACD histogram, and the green, the yellow, orange, red dots kind of tell you how long things are squeezing for. So you want to look for when the histogram, right? You want to look for the histogram to be kind of like MACD upsloping or downsloping, and you also want to look for the squeeze dots, the indicator that shows you when price is kind of squeezing and then releases like the energy, like it builds up energy and then it releases like Kamehameha. I use a strat. I don't really use it completely. I kind of follow how it works and kind of is aligned to how I trade. So, it's useful. A strat is kind of just following price action. You don't need indicators to understand price action. It's kind of like, okay, if it goes higher, then if it breaks out here, it can go higher. If it breaks down here, it can go lower. If the range is inside a previous day, then you get chopped up, right? You only want to trade prices when it's clearly going up or clearly going down. That's kind of like what it's saying. Like the broadening formation. Yeah, Tio has good explanation. TTN Squeeze, check that out. Yeah, man, resources. I don't know everything, right? I try to research as much as I can. Yeah. Broadening formation. That one was interesting. I never used broadening formations, but it shows how price moves in a series of formations. So interesting. Stick to a certain watch list, learn. Yeah. I mean, two different types of traders. One trader, has the same edge and looks throughout the entire market for the edge, works, right? Some traders, only trade a couple instruments. So, some pros out there only trade the SPY, only trade QQQ, Assassin AR-15, excellent example, right? Only does 3 indices, that's it, right? For me, my watch list same every week. It's tech stocks. Why? Tech stocks volatile, and they have high upside, growth stock. All of those stocks are in a strong uptrend for the past decade, right? I like those stocks. They move. If you're doing naked options, right, buying and selling calls and puts, you want to trade stocks that move, that can move big, right? So if you're doing smaller stocks, the options will be cheap, but you're only gonna make like a little bit on those moves, $1, $2 moves compared to 5, 6, 7, right? Reward is higher, a little more risky, but if you study them long enough, you get to understand them more. It's like, who said this before? I don't know who said this. It's like relations, like getting in a relationship. You can't date somebody after the first date. You want to get on like a couple of dates, or you want to know them for a little bit. Take time to learn, understand them, and build a connection with them. Doesn't mean fall in love with the stock, right? It means you know them well enough so that when you do trade them, you're not nervous about what may happen next because you've studied it a long time, right? You understand it better. You know the risk behind why a stock goes up or down. You know what types of news affect the stock. You know the sector well, right? So, yeah, two different types. Up to you. I like sticking to a small list. I experience FOMO very easily. So if I look at random stocks and it moves and I could have gone like, bad, very bad. So I stick to 10 stocks. And that's it. Nothing happens in 10 stocks. I don't do anything. Something happens, cool. I take something. But there's hundreds of stocks. You can't watch all of them. And it's easy as a trader to get FOMO, right? Very easy. You see something move without you. You have fear of missing out, right? So, yeah. All right. That's, yeah. Tell me to delete those stocks. But all right. I'm gonna stop recording now.